I would like to welcome you to part 3 of tonight's Opportunity Zone Meetup. In this segment of tonight's program, we have a guest, Sean Covi, who's an expert in all kinds of interesting and very valuable, I'm going to call them tax considerations, ways in which you can reduce your taxes or do things with them that may help you advance your business plan. So Sean, please take it away. Thank you.
Thank you, Carl. So we're going to cover specialty tax incentives and some other tools that are going to have the potential of enhancing a rate of return to an opportunity zone investment. So I'm breaking them down into 2 categories. We're going to start with those categories that are real estate related, so someone who's going to operate as a landlord, and then the growth producing businesses where they may or may not own the underlying real estate. So traditionally what I'm going to talk about tonight is not spearheaded by CPAs, CFOs, or other financial specialists inside of a business practice. So they tend to require outside specialists. They may dovetail with what a CPA or a CFO does, but it's usually not something they will do on their own. With the commercial real estate focus, we're going to have 2 topics we're going to talk about. The first is going to be engineering-based cost segregation. Second is going to be property tax remediation. And then for the business side of things, we're going to talk about work opportunity tax credits, research and development tax credits, and for specific businesses, the ability to get exemptions from state and local sales taxes that are assessed on utility bills. So we'll start with the real estate tools first. Engineering-based cost segregation is a tool that allows landlords to be able to accelerate their depreciation, to take depreciation from the back end of the time frame, move it up front, and compound the savings that they're going to get. It's essentially available to businesses that are either building a new building or purchasing an existing structure or have purchased it within the last 20 years. So there's a wide range of buildings that can qualify. The ownership entity that's going to purchase the building should be profitable. This is not a tool that's useful if someone's running a net operating loss or if they're operating at break even. So what we look at is incoming revenue, and then taking expense deductions for running the property and ordinary depreciation. If after that there are significant income taxes due to income, then this tool is something that can be effective. It enables accelerated depreciation. This is something that was further enhanced by the Tax Cuts and Jobs Act, which created opportunity zones. So they doubled the amount of accelerated depreciation that building owners can take. And business personal property is the type of property that we're discussing here. So if you look in around the room that you're sitting in, it probably has floors, walls, ceiling, lighting, possibly built-ins. All of those things and more, in many cases, landscaping outside the building, etc. All of that is considered business personal property. The easiest way for me to help you identify that is if you were to renovate the building you're in, most things that would be ripped up and thrown away are business personal property, as opposed to the structural property that the building is connected to. The amount of savings that can be driven from cost segregation is usually between $40,000 and $80,000 for every million of cost that goes into the purchase of a building. The range there depends on the inner walls. So an office building or anything, a hotel, more inner walls tends to be at the higher range of that 40 to 80,000. A warehouse or a space with less inner walls tends to be at the lower end of that range. So there is going to be a range depending on how much business personal property is in there. What do people do with that savings? Well, if they utilized leverage to acquire the property, they can reduce that leverage if it makes sense in their business plan. If they want to create additional investments, maybe they want to buy additional properties or fund a business that's starting within the building that they've purchased, they can utilize the savings to make additional investments that way. There's no restriction on how it can be used. And then it can help reduce property tax. We'll get to this in the next slide. Here we go. Property tax mitigation. This is unique in that every 2 years we get automated assessments of our new property value, and they're not done by a human being. There's not one person who takes calculations for every single property in a county, town, or city. It's all automatic. And for the most part, it makes sense. But oftentimes there are discrepancies that we need to argue, which could say the value should be less than what the automated system came up with. There are 4 specific methodologies behind how we can argue those changes: cost, market, income, and uniformity valuation methods. Often you can combine 2 or 3 of those together to argue the case that the property that you're discussing doesn't have the same value. It actually should be lower than what the county has or the city has assessed it at. Now, there are 3 levels of appeal when you want to argue your property tax valuation. The first one is you usually write something, send it in within that 1-month window that they give you. 90% of the time, that's rejected. Flat out, nope, we don't agree with you, stamp no. Most people end right there. Okay, I tried, I didn't get anything out of it. There are 2 further levels of appeals where you actually get people to think a lot harder about the arguments that you're making. If you're not familiar with those, hiring a specialist team who is going to be an integral part of reducing property taxation. Because just like hiring a specialty doctor or a specialty attorney, they're usually going to get a lot more results than if you just hire the entry-level person who's helping you with something like that, like a general practitioner versus a surgeon. And then finally, challenge in court. If the 3 levels of appeal are not accepted and there's still a strong case to be made, this can be taken to court and can be argued there as opposed to just a procedural governmental level. Now, how do you do this? Well, if you're hiring a specialist, there are usually 2 ways to hire a specialist. One, agree upon a fee, hourly or a flat rate, pay them that fee, they do the work. Whether or not they generate a result for you, the fee is due and payable, quite often in advance. Or many people in this space will work on contingency, meaning if they do not deliver a reduction in your property tax, they don't charge a fee. So now there's an incentive for them to really take your case seriously and get something done. The fee comes on the back end. Oftentimes the savings that is generated is split 50-50 for the first year of property tax savings, and then ongoing years it inures fully to the owner of the building. So there's no risk involved, but in the event that they generate significant savings, the fee might be a little higher than what you would have paid had you engaged them on an hourly or otherwise rate that way. In order to find a specialist where there's enough value in a contingency agreement, usually they're for buildings who have at least $30,000 a year of property tax due. So it's not going to be for your smaller buildings, it's going to tend to be your medium and larger size buildings that would create enough savings to warrant both parties getting some value out of that. Then, as I mentioned on the prior slide, cost segregation, what they do is we put an engineering list together of the cost of the floors, the walls, the ceiling, the built-ins, the lighting, etc. Those items here in Colorado and in other states around the country, you're allowed to submit those to the property tax authority and indicate that they are business personal property as opposed to business real property. Usually the tax rate is the same, so you're not changing the tax rate. What you're changing is they hold it at cost. So every 2 years when you get those notices in the mail that says your new assessment is X and it's often higher than it was 2 years earlier, that doesn't happen for the items you put on that list. So we find often 20 or 30% of the cost of a building is business personal property. So if we can reduce the future compounding or inflation effect of the valuation increases by holding 20 to 30% of that from being applied to those increases, that long-term creates savings as well. So essentially 3 ways we just covered now to reduce taxation on property, whether it be income tax or property tax. Now, The other methodology we're going to talk about is not necessarily related to owning the building, but is more related to owning a business that's being run. These don't apply solely to opportunity zones, but they can be used inside of opportunity zones to further enhance the rate of return or the tax savings that someone can get. So WOTC, Work Opportunity Tax Credit. The acronym stands for a federal program, but quite often it's used to accommodate many other state programs. They're all tax credits that are based on hiring employees from certain target categories. The categories include veterans. There are 3 different types, not all veterans, but veterans from 3 different types of backgrounds, including those that are unemployed at the time they got hired. People who live in empowerment zones, which are very different than opportunity zones, rural renewal counties, summer youth workers, ex-felons, but the biggest one that most people don't know about, as if they know much about this at all, is people who live in multi-generational households where one person in that household is receiving aid for needy families or food stamps. When that happens, so picture grandparents, parents, youth, aunt, uncle, all living at the same household. One of them, let's call it Aunt Sue, she's receiving food stamps from the government. Everyone else at that household, when they get hired, brings a tax credit to their next employer. The problem is the employer needs to identify it and the employer needs to do the paperwork to capture it. Well, number one, most employers don't know it, and certainly the employee or the prospective employee about to be hired usually doesn't know it either. And this particular credit is one of those that turns into a pumpkin at midnight, my Cinderella example here. So if you don't do the right paperwork at the right time when making the job offer, even though you would have been eligible for a credit, it goes poof and you're not going to get it. So it does take some prospective planning here. Approximately 10% of the country brings this tax credit to employers. In some industries it's smaller than that, in other industries it's higher. Oftentimes manufacturing, entertainment, hospitality tend to be industries where there's more concentration of employees from these target backgrounds. Now I've been asked before, is this a violation of federal prohibitions on identifying different categories, right? Gender, race, etc. These aren't those categories. These are actually categories where the federal government has said these are groups that are traditionally and or chronically underemployed. So they want to incentivize businesses to hire from these groups. They want you to choose these people over other people. So they're not getting into the protected categories. These are entirely different root categories. The credits range from $900 on the low end to almost $10,000 on the high end. The $10,000 is the veteran category. It's the only one that pays that much, the 3 different types of veterans. And if anyone is not aware of this, a tax credit is different than a tax deduction. A tax deduction is where you have income and you have some expenses and you write those off, it reduces your income and you pay tax on the balance. A tax credit is a dollar-for-dollar reduction in that balance of taxes owed. So quite often they're larger in terms of net savings when you get a tax credit than when you get a tax deduction. But again, everything's relevant depending on the size of things. Once an employee, this new employee, assuming all the paperwork's done properly, once an employee has worked 120 hours, the tax credit has been earned. You can earn a little bit more if they work over 400 hours, but it really depends on a number of factors. So at 120 hours work, the credit is earned. And if you can believe this, it does take about 9 more months for the state workforce agency to process it and actually get us the data to put the credit in the employer's account, so to speak, which is giving it to their CPA. So governments are not fast in that manner. There are specific time frames in the paperwork. This industry has catered, the WOTC industry has catered to businesses that hire 500 or more people a year because they're throwing it at the wall and see what sticks, and they're going to collect on what they got through, even if not all of it went through. Well, there are businesses out there that cater to the smaller business here, where if they hire one person, they can use automated software to figure out, is this person eligible, my new hire, of bringing me a tax credit? And can I hire the company to do all that other paperwork, and I just have my payroll person identify when they work 120 hours. Boom, credits earned. They pay a portion of the credit to the company who does that. They keep the lion's share. So advances in technology have enabled this particular tax credit, WOTC, to be used in a much broader capacity than it has in the past. R&D credit, we're on the second to last topic. Research and development. Businesses who do some element of science-based work in what they do. And that's a very broad statement. You don't want to get stuck up on the word or the phrase R&D. Many of us think of that as pharmaceutical product development, and yes, that certainly fits. But here, for this particular purpose, the category is much more broad than that. So any science-based work. Notice there are a lot of industries. Well, I suppose you'd notice if I click the slide. There you go. Manufacturing, software, engineering, architecture, breweries, hemp, and dairy farming, and many others on top of that. So there's many different ways that this can be utilized to capture tax credits. So the biggest thing is W-2 payroll. So yes, if you're spending on equipment or other systems, that'll count as well. But the payroll for the employees operating those systems in the process of creating something is the biggest factor in generating this particular tax credit. Startups get a unique benefit from this. Within the first 5 years from the date they got their first penny of revenue for their business, so you could start up a business and not get any revenue for 2 years. Within 5 years from the date of first revenue generation, and as long as they're under $5 million a year in revenue generation, which again, kind of definition of startup, they do not have to be profitable to get this benefit. Now think about it. You have to be profitable to pay tax to be able to get a tax credit. Here, for startups, they're able to offset their employer share of Social Security and Medicare, FICA tax, which employer pays half, employee pays half via payroll deductions. So the employer can capture this particular tax credit and get a refund of their employer FICA up to the amount of tax credit within that first 5-year period. So something to be aware of. And then we can go back 3 years as applicable for a business that has not utilized this, identify the proper tax credits, document it for audit protection purposes, and this is the most important part. You can put a number you want on your tax return. Under audit, if you can't justify it in a particular written format, you're not going to be allowed to keep it. So having the document that line by line underscores what was done by which employees and how much time and pay did they receive for that, that's what the group I work with does. And we can go back 3 years and get refunds of prior FICA for startups and prior taxes paid for highly profitable companies beyond the startup period. Lastly, utility sales taxes. Most of us are aware that when we go to a store, say Walmart, on your receipt, there's going to be sales tax for whatever product you purchase. Now, some things in the grocery section might not be sales taxable, but most products have sales tax associated with them. Utility bills are no different in most states. 45 states in the country charge sales tax on their utility bill. West Coast, Washington, Oregon, California, Nevada, Arizona don't, but most states around the country do. And we have the ability for manufacturing or agriculture businesses, not retail, so they have to be manufacturing or some other way involved in creating a tangible product, software included. We have the ability to come in and measure the draw of the utility consumption and separate out, did I put that up here yet? Separate out administrative from production. And let's say 90% of utility usage is for the equipment making the product versus the hallways and the conference rooms and the computers for administrative stuff. We're going to get a 90% exemption of that sales tax. So for small businesses who have a utility bill of $200, $300 a month, this isn't that useful. But once you get into manufacturing or businesses that have high utility consumption, and now we're talking thousands a month or tens of thousands a month in utility consumption, this can add up to hundreds or thousands a month in savings as well. So it can be pretty significant. 4 to 8% depending on the county where the business is located, so that's the amount of reduction because that's the amount of sales tax. It varies by county. Real estate ownership is not required, so they can simply own the business and be renting from the landlord in the Opportunity Zone. And again, this is not restricted to Opportunity Zones. We do also have the ability for businesses that have been in place for a while, so maybe it's not an Opportunity Zone business, but we have the ability to go backwards potentially 3 years and get some refunds of prior sales taxes paid on utility bills as well. And this works in a number of different industries, including in states where it's legal, cannabis grow operations, which are very utility intensive as well. So final slide, what are the benefits of combining specialty tax incentives and opportunity zones? Well, one, reduced cost of ownership and operation. I think we can see where those come from. Increased cash flow and profit. The option to reduce debt or increase investment spend with the results of this particular savings. Strategic utilization of Opportunity Zone fund tax benefits. What does that mean? Well, on Opportunity Zones, you're getting mostly capital gains related tax mitigation of different types depending on how long you hold the investment, whether it be the building or a business related to that. Well, here you have the ability to offset income taxes or employer FICA taxes, which have nothing to do with capital gains. So we're enhancing the ability within an opportunity zone to get other tax incentives that are not particularly tied to opportunity zones, but they're available. And then compound of growth of current savings. So when you're able to take savings that you didn't know you were available, or taking from the back end and front-loading savings, you have the ability to compound on that, and that's where a lot of value can be driven. So those are the end of my prepared comments. Any questions before we wrap up this? Yes?
On the R&D, there's a couple things about R&D operations, the true R&D operations. They have a lot of equipment, labware, stuff they have to put inside the building. Is that business personal property?
Excellent question. When we talk about business personal property, they're usually attached to the building and not easily removable. So in the idea of lab equipment, while it may not be easily removable, meaning you're not just going to pick it up and walk out the door with it, it's usually not necessarily attached other than it might be heavy or maybe bolted to the floor, but it could be easily undone with undoing a simple bolt. Usually those things will be accounted for by the CPA already because the CPA knows the cost of those things and they can do cost segregation, which is essentially putting it into an accelerated bucket, 5, 7, or 15-year depreciation. When we're talking about engineering-based cost segregation, they're usually for things that the CPA can't price. Why? Well, you go out and buy lab equipment, you get a receipt for it. CPA can price it. It's super easy to depreciate it. They know exactly which bucket it goes into. When you have flooring and walls and ceiling and built-ins and bookcases and all those types of things, they don't necessarily come with a price tag. There's not something that a CPA can easily refer to and say, oh, the carpet or the hardwood floors or the tile is worth this much. That's usually not within their experience level of being able to price quote those things. So that's where an engineer comes in, and it has the background using IRS-approved formats to be able to put a price on those things.
When you build a laboratory, you usually at least double the HVAC costs, and usually double, if not more, the electrical utilities cost. Is that something else that's now an engineering study, or
Yes.
over and above what it would as a warehouse or as an office building?
Yes. And HVAC is, I'm not going to use the word tricky, but it's different. In some cases, HVAC is not eligible for the R&D tax credit. In other cases, it is. An argument has to be made that it was integral. So in a lab situation where you can't be using the equipment and the equipment does count, then you could argue that the HVAC does. In an office situation, you can't really argue that it's integral. It's part and parcel, but not integral. You can operate in a building without HVAC. It might be a little sweaty, but you can do it. So there's a difference between integral and not integral there.
Yeah, in the case of labs, you have to exchange the air.
Yeah, exactly. There's a lot of features there. Yeah, so now that was addressing cost segregation. Labs often trigger R&D as well, because a lot of the work, of course, that they're doing is science related. So there's two different things we've discussed there. One is the real estate related end of things. The other is non-real estate related, which is research and development. You could be renting the location and still be able to get the R&D tax credits. So they come from different angles.
Thanks.
You're welcome.
We'll take up the rest of it in our panel.
All right.
And so let's take a break.